Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. It's been quite an eventful last month or so, with a number of key events to recap on, and hopefully over the course of the next sort of 45 minutes or so, we'll be able to inform you on what we think is going to happen moving forward. But in terms of the macroeconomic environment, the things I'm going to run you through today include what's happening with the latest bout of economic forecasts. We'll then move forward in terms of looking at what's happening on inflation and interest rates. There's also a brief piece on updating regarding the US regional banking situation. There's been some developments there. Following on from that, some FX market forecasts and a disclaimer thereafter. But we'll quickly dig into the detail because it's quite a bit to get through, and go on to the next slide and look at the economic forecasts. We've seen something slightly unusual where the International Monetary Fund have had to again upgrade the forecasts for the UK economy. So they would normally not do this until July, when the next forecast change is due. But for whatever reason, they've decided that the numbers are completely wrong. And so they've upgraded the UK again. It's quite a big upgrade, actually. It's an upgrade from minus 0.3% to plus 0.4%. So taken against the January forecast, that's an upgrade of a full percentage point on where they expect the UK economy to be. It's an enormous increase in expectations for the UK. Now, the IMF said, look, we got it wrong. There's been some very positive developments with regard to the energy prices. There's been other positive developments in terms of economic activity, investment, and so on and so forth. I think this is an admission that they were just looking in the wrong direction. I said on previous calls, it was very unusual for the UK economy to be performing so poorly when its two major trading partners, the US and Euroland, were performing better. So a recession in the UK, independent of what was going on in the US and Euroland, just didn't make sense to me. And this appears to be that admission that they now agree with my suggestion, my way of thinking, rather than that actually there has been this big improvement and significant improvement, particularly in energy prices, because energy prices were already on a very sharp downward track by the time of their April forecast. So perhaps they were just using out-of-date data. The other thing to note with regard to the IMF forecast is that they did marginally upwardly revise the outlook for the US and also for Euroland, but the data from both of those economies lately would suggest that certainly into the end of the first quarter and the beginning of the second quarter, things have been somewhat more challenging. And in the US, we continue to see that challenge manifesting itself in consumer spending, in the housing market. In Euroland, it's been demonstrated in the industrial sector more so than in other areas, but we are seeing stress in retail sales as well. So I think there is a real challenge here in terms of Euroland and the US economies meeting those growth expectations that the IMF have. And we've recently had an update from the Office for the Organization of Economic Cooperation and Development. And they say that the US and Euroland economies probably going to grow slightly slower than was previously expected by the International Monetary Fund. So just watch out for that, because I think that we could be seeing some downgrades to US and Euroland growth over the July forecast change from the IMF. We move on to the next slide and we look at what the latest developments in inflation have been. Well, the biggest thing to flag here is the drop in UK consumer price inflation on a headline basis. So it dropped from 10.1% to 8.7%. So it's bringing it more into line with the falls that we'd previously seen in the US and Euroland consumer price inflation numbers. The notable thing as well, though, is that in Euroland, we've seen a big drop in inflation expectations. That's not something that's been replicated in the UK as yet. So I think that makes the European Central Bank's decision a bit harder than it otherwise was. When they meet next week, I don't necessarily think that they're going to have an easy time of it convincing the press and the markets that if they do raise interest rates, that they're doing it for the right reasons. In the US, we're continuing to see inflation dropping. But there is the suggestion that the pace of improvement, particularly with regard to core inflation, is starting to slow down. So just watch for that, because that might still be the reason why we get one final rate increase from the Federal Reserve, as they've been hinting at. The June meeting is a pause potentially in the aggressive monetary tightening that we've seen, but they still leave the door open for more monetary tightening if necessary going into the second half of 2023. So we're moving on to the sort of interest rate decisions, and the forecasts for the Fed, the Bank of England, and the European Central Bank have materially changed. So much higher peak for UK Bank of England bank rate. The forecast for the US Fed is that they, as I say, they have the potential to raise interest rates a little bit further, but the likelihood is that rates won't rise much further than the current 5.25%. But the market has shifted the timing of the first rate cut to early into 2024 rather than late in 2023. So they're delaying any rate cuts from the Federal Reserve now. With the European Central Bank, there has been a bit of a change there as well, in terms of the peak is now set to be somewhat lower, and the rates are expected to come down slightly quicker as well, again, because of that adjustment in inflation expectations. I think the other thing to note here is that from central banking perspective, they continue to ignore the money supply data. And the money supply data is something that is particularly concerning to me, because it does demonstrate that you've got a disinflationary environment potentially building in these Western economies. One other factor around money supply, particularly with regard to the UK data on money supply, is we've got conditions that are very unusual. So mortgage lending actually fell quite sharply in the April reading, and I say that's unusual. I've looked back at the data set, and I can only find 3 occurrences in the last sort of 25-30 years where mortgage lending actually falls on a net basis. So normally, because house prices are going up, because underlying demand is going up for housing, you would normally see a rise in net mortgage lending. You've seen the second consecutive fall in mortgage lending, but a much bigger fall in April than we saw in March. It was only marginal in March. And the third fall that I could find was back in 2021, when we were just overcoming some of the problems around the pandemic. So I actually discount that one. These conditions are much more troubling as far as the UK housing market is concerned. Moving on to the next slide and looking at the US banking problems. Now, these indices are the KBW Banking Index and the KBW Regional Banking Index. So they're equity indices. What you can see here is that when we are hearing about that everything is fixed as far as US regional and larger commercial banking operations are concerned, that doesn't appear to be reflected in equity valuations. We're basically back to levels that we were seeing in the midst of the pandemic. And I don't think that confidence has been restored. I think there's also an ongoing crunch on credit, one that may be added to by the fact that the Federal Reserve is saying that it's going to expand the requirements for capital reserves to the larger regional banks. So anybody now with a overall asset book of $100 billion whereas it used to be more than $250 billion, going to have to hold more capital on reserve. I think that could exacerbate the squeeze on lending. It could slow down the pace of credit creation and further increase the reductions in money supply. So currently US M2 money supply is minus 4.6%. We could see that getting even worse as we head through the remainder of this year and into 2024. What does all this mean for FX markets? Well, if we look at the FX markets slide, so the next slide, what this shows is that the forecasts haven't really changed that much, with the exception of dollar China. And I wanted to focus on dollar China for just a second, because we have seen dollar China now moving up through 710 and on towards 715, although it hasn't got to that level yet. I think in the sort of 715, 720 region, dollar China might start to struggle for further upward momentum. And you can see from the forecast that we're expecting dollar China to slip back. So if there is a risk, it's that we're probably getting close to a peak as far as the current recovery that we've seen in the dollar index. So it has rallied a bit over the course of the last month or so, since the last call that we did, and it's the last webinar that we did. I think that we might be in a period of consolidation as far as the dollar index is concerned. Might even see sterling dollar and euro dollar making some gains back against the losses that they've seen over the course of the last month or so. Although worthwhile noting that sterling dollar actually did hit its high after the last webinar that we did, got close to 127. Sterling euro only a few days ago was up towards 116.75. Potentially pushing on towards 117. I think we are running into areas of congestion. There are some ongoing geopolitical risks. If those manifest themselves, I think that could be quite negative for sterling and euro against the US dollar, more positive for the US dollar in terms of it being the global policeman against some of those geopolitical risks that there are out there. So I'm going to stop talking now and hand over to Piers. Just last slide, my disclaimer, before we hand over to Piers. As I say, plenty of time for questions and Q&A at the end. We've already had one pre-submitted, but do remember to hit the Q&A button and type your questions if you do want to ask something. Without further ado, over to you, Piers, and looking forward to hearing what you have to say of the developments of the last month and where we see things heading forward from a technical perspective.
Thanks very much, Neil. Very good presentation as ever. And I'm on fire if I can follow that as well as you started off the presentation. Before I start, I just want to give you big credit here because I have a very small amount of fundamental knowledge. And one thing I've been impressed with you is all that gloomy figures from the IMF and all the other economists on sterling. You've been doubting those figures all year, saying, how can it be? And I was surprised on the news the other week. I just saw that lots of economists are changing their views. The IMF had changed their forecast. So credit where credit is due. Nice human touch there. Well done, Parky. So now we'll go on to the technicals. So the first slide we're going to look at is coming up, hopefully. Next slide. And the next slide, one more. So the first start, we're going to start with the dollar index. So it's the same chart as we looked at last month. Now, one thing here is last month we saw that price had just closed just slightly below the 20-period moving average from the Bollinger Bands. And I said that, the dollar needs to regain that to stop this pullback lower becoming more pronounced. So it'd be important to see who has the strongest will when it comes to closing that month clearly below the 20-period moving average. And so we could see a good two-way fight. Well, last month saw price rally really strongly, and it closed way back above the 20-period moving average. So we did have a confirmed clear break. Remember, in technical analysis, you always need two closes for a true break. So the dollar proved tougher than the rest again as it fought back. Now, where would we look now? So I would say now we can move support up to the 103, 102 area. And that 102, 103 area should be the support. Resistance is initially in that sort of where that 38.2% line is, 104.50, 105. And that's where it needs to get above to build on last month's strength. But the one thing we do have coming is we have next week, we have the FOMC and the ECB. So that is going to be the deciding factor here, I think, as to how this pans out, this rally back off the 20-period moving average. So we need to keep an eye on that. But what is important is that the end of this month is the end of the second quarter. So next month, we're going to look at the quarterly charts. It'll be very interesting to see where this all looks like for a longer term view on the quarterly charts. So at the moment, I'd look at 102, 103 as support for the dollar and 104.50, 105 area as resistance. Now, we have been slowly making lower highs and lower lows in this move down. And it'd be interesting to see if the dollar can actually make a higher high in this rally back up. And that's going to be something I'll keep an eye on. So if we go to the next slide now, here's euro dollar. And again, this is the same chart as we had on last month's webinar. And although the previous month had seen a monthly close above the 20-period moving average, I was saying, be careful, because as price nears that old trend line, that dashed line, as price nears that trend line, I said the risk reward could be that price starts to fall back lower. And we saw that happen. The other thing I put on there was divergence as well. We had negative divergence on the bottom of the chart. I've highlighted that purple circle. And that was another warning that actually this move higher was at risk of turning round. And that divergence was a good warning as the selling and dollar strength did arrive just ahead of that trend line. And where's it taken us back down to? It's taken us back down to that 20-period moving average. We're right on it now. But what would I do at the moment? At the moment, I'd watch 107.77 as a pivot. And while below that level, then it has a negative feel, euro dollar. If it can get above that 107.77, then that negative feel goes. So it's all going to depend, as I said, on the dollar index. You've got the two central bank meetings next week, and that's what's going to probably decide the fate here. And I don't know on that what's going to happen. The market doesn't know. Will it be a shock? Will the forecasts for what's going to happen be right, or will they be wrong and the market has to react? Now, we know above 107.77, the negative feel goes slightly. But where's the main levels? I think if you get below 106.20 on any monthly close, that would be very negative and open 105 and 103 potentially. So keep an eye on that. To escape the negative feel, we need to be back above 107.77, as I said. But really to get positive, you need it back above 109. And then euro dollar have taken one step up, I feel. So we go to the next slide. This is the sterling index monthly chart. Now, here we have the retracements of the move from 2015-16. And we can see that, again, prices going higher. Last year, when we had the Liz Truss crash, that was that spike on the bottom, and it formed that morning star. And ever since it's formed that morning star, prices really just rallied up. Now, interestingly, on this chart, on the monthly chart, you've closed above the 38.2. But we've seen that in the past. It's more important when we get to the quarterly chart next. So what's stopping us at the moment? For the last 2 months, sterling's just been held by the top of the Bollinger Bands. So on the monthly chart, I'd say that it is actually looking positive, sterling still, but it's reaching an area where it might just find some selling. Where would I turn negative? To get negative, you have to get back below that 20-period moving average. And that I will keep you posted on. So at the moment, I see it sort of trading between this sort of 66 and maybe down to sort of 63 area. Below 63, you'd start to worry, is sterling starting to suffer? Above 66, and things are looking good for the sterling index. But what's more important always is the next slide, which is the quarterly chart. So this we've gone on for years about this chart. You can see the highlighted area underneath. I put for 5 years, we saw the sterling index held by that 38.2%. Now, we're above that 38.2%. So it's quite an important time. What's it being held by? It's being held by the top Bollinger Band. It's tried poking above it, and it's just coming back within it. But this is positive stuff. Now, can sterling hold on and close the quarter above 38.2%? Because that would be quite a significant feat, I think, for it to actually get above there. I think you'd like to see it above the Bollinger Band as well, just to give you that comfort that, yes, this is a true break happening here. So we'll cover that next month, because that is going to be the quarterly chart session, and we'll see how it closes on this quarterly chart. But as you can see, we've got that mid-Bollinger round about that 63 area. So that is going to be really your period where you say things have changed if it gets back below there. But the Bollinger Bands are actually starting to widen out after being very narrow. So it's very slight at the moment, but if you look at that top Bollinger Band, it's starting to point up, while the bottom Bollinger Band is pointing down. So normally that gives you the directional break, and it does sort of suggest that maybe this is it. This is where sterling starts to strengthen up. And let's hope so. You know, that'd be very good, because if sterling returns to that sort of promised land of stronger sterling, it'll be just in time for our nice holidays if we're going overseas. So if we go to the next chart, how does this look in the actual currencies? So sterling dollar, this is a chart we've looked at for the last, well, quite a few months. We had the old support, those 3 circles at the start of the chart, then price broke below it, then price went back up, and rule of polarity, it swapped round, the old support became resistance. And what's happened for the last 3 months? The old resistance has now switched back to support. So you can see for the last 3 months, that band has kept it. So where do things change here for sterling dollar? If it starts to get below 121.60, then that's a false break. And it's the 61.8% area has held it, that 127.5. So if you want sterling dollar higher, what do you need to see? You need to see sterling dollar above that 27.60, and that will be a confirmation that the support has held again and we're breaking to the upside. If you start to see it break down through that support zone, then sterling dollar is in a bit more trouble, and we're probably heading back down towards that 118 area. But if we look at the next slide now, this is with the Bollinger Bands on. And you can see, look, for the last couple of months, and including this month, you're trading around that 20 period moving average. So it hasn't quite got the strength to break through it at the moment. And that's what we've got to keep an eye on. You know, I said last month, keep an eye on that. Can it break through? This is going to be the tough time for sterling dollar, because if it can break above that and clear away from that 124.40 area on a monthly close, then potentially we are going to see a rally. But if it starts just to back off that 24.5 area, then we might be going back to the badlands of down low sort of 118 area, maybe lower. So we're going to keep an eye on that. Next month, as I say, we've got the quarterly chart. And at least when we look at the quarterly chart, the rate announcements for next week will be out and in the price. So we'll have a much clearer view, I feel. If we look at the next slide, this is euro sterling. So on euro sterling, after a few months of being trapped sideways trading, we've suddenly price took its lead really from the break of the trend line, and it was blinded by the light and crashed lower. It really had a big move down. But where did it stop? It stopped right at the 20 period moving average. So you're on there. And that was the sort of lows last month. And euro sterling seeing a bit of a rally off it this month so far. However, the big thing is always looking for what's the dominant candle? What's the one in charge? You always want to know who's in charge. When you go in a room, you'll get a dominant person in that conversation when you join a group of people. And it's the same when you look at markets. So the previous dominant candle was the green one, which I have circled. And you'll see after that, for the next 1, 2, 3, 4 months, the midpoint of that provided support. But last month, with the break of the trend line, price crashed lower. And so now the dominant candle is that one, that large red one. So I think that as you see any rallies back towards 86.90, 87.10, they might start to struggle. So the risk is below 87.50. I think this could go low. And I think you could see a move towards that 84.65 area play out. Now, the next slide is for all of those people who like sterling euro. So on a sterling euro, same thing, but the other way around, just the mirror image. You had the previous dominant candle was that red one from the end of last year. Now we can see that it's turned. We've broken the downtrend. Price rallied after that. Where's it stopped at? The 20 period moving average. Where's the new dominant candle? That large green one. So on sterling, I would say that above 115.25, price is good because that's sort of the midpoint area. So I think that will be a good area. And I think that you could see a push up towards 115.80, 115.90, and only if it got below 114.80, 115, would I start to worry that something's happening. And the risk, while above 114.25, I think is a test higher to come towards maybe 118.20, 70 area. And that'd be the glory days for our summer holiday, if that does happen. So that is actually all my slides for the moment. I'll leave you with the disclaimer, which is on the next page. And it'll be interesting to see how the quarterly charts look next month, because we'll have got those, all the rate decisions will be done by then as well.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.